Eric Singer, I've heard of a presidential effect on stocks, but what's the congressional effect on stocks?
The congressional effect on stocks is the market's reaction to the uncertainty that Congress creates. You know, people don't always have to get to choose the day that they're going to sell a stock. Daughter's getting married, maybe getting divorced, got to buy a house. So people have to sell stocks every day, but they don't have to buy a stock every day. If the rules are changing for the bank stocks, maybe that's not a good day to buy a bank stock. And over the years, as Congress passes legislation and sometimes just thinks about passing legislation, it creates uncertainty in the market. It has a huge impact in the market. Going back to 1965, day by day, there are 12,000 trading days. On the 7,900 days that Congress was in session, the market went up annually less than 1% in price. On the 4,100 days that they were on vacation or out of session, as they call it, the market went up 16% in price. That's the congressional effect.
All right, so you sell when they convene and you buy when they recess. So tell me, how do you trade it? Is it in individual stocks or indexes? Tell me how you trade the congressional effect.
Well, I have a mutual fund where my the mandate in my mutual fund is to be at least 90% long on the days that they're on vacation and out of the market on the days that they're in session. So, and we do it just with the S&P. You can also trade the congressional effect by looking at situations or industries where you think that the industry has suffered too much because of congressional interference and seeing if it's been overdone and it's time to invest.
Well, the mutual fund is trailing this year. It's trailing the S&P. S&P's having a pretty good year. What do you count that underperformance to?
Well, when you have a straight up S&P, I'm going to tend to be underperforming because when they're in session, I'm flat, and if the market's roaring, I'm going to not participate that. By the same token, in 2008, mutual fund was down 2% when the average mutual fund was down 43%. So although we trade on a daily basis, it's actually something that requires a very long-term approach. And over the last 5 or 6 years, we've trailed the S&P by a little over 1% annually, but we have half the risk and a quarter of the correlation. So that's what the purpose of this fund is.
And the year's not over yet.
And the year's not over yet.
A pretty volatile October so far. One thing I want to distinguish, though, is there's been a lot of talk of insider trading within Congress, and they've added some rules to keep Congress people from trading on news that they might hear in one of their private deliberations or a private session with a business leader. This is different from that, correct?
This is different from that. You know, there's a lot of documentation on Congress's insider trading. From 1993 through 1996, for example, the 535 members of Congress on average outperformed the S&P by 10%. That's like saying the 535 members of Congress were better than the top 1% of all mutual fund managers. In 1998, 1997, when Congress wasn't doing anything because it was impeaching the president, they stopped being outperformers and they went back to being normal traders. Congress used to have an information edge for making their own personal money. This is different. This is the impact on all of us as investors.